By now, I think you understand that the IRS is going to get their hands on your money either while you're alive or when you die. You're going to have to pay taxes on your money that you make. Today, we're going to talk about specifically how non-retirement assets work as far as capital gains go, either to a surviving spouse or beneficiaries, because there are a couple different rules for both. I'm JD White. This is the Retirement Cheat Code. Let's go ahead and get into this one. Before we jump into this, I want to make sure you know that I'm going to drop a link down below in the subscription for a video on after tax accounts. That is what we're going to be talking about today, specifically non-retirement assets. And what that might be is maybe a checking or savings account. This could be your real estate, your primary house, a rental property. This could be a investment account that you own by yourself or jointly with someone else. This could be cryptocurrency, precious metals, collectibles such as art, silver, jewelry. So this does apply to a lot of things, but specifically these are not held inside of a retirement account like a traditional IRA, a 401k, a Roth IRA, or anything like that. These are normal accounts. Some of them do pay taxes as we go if you're getting interest payments or dividend payments. Some of them only get taxed when you sell them or die and leave them to a beneficiary. So the first thing to understand with capital gains, that again, capital gains is a tax that you pay when you buy something at a certain price and then sell it at a higher price. You owe what's called capital gains tax. And those taxes vary from asset type to investment type. So for like collectibles, it's a 28% tax. For stocks, bonds, it's a 15% tax. For real estate, it's a little bit different. Depends if it's primary residence, rental property, those kinds of things, typically a 20% or 15% tax. So there's a lot of variables in there, but just know that capital gains tax is when you buy something and then sell it for more than it was worth. When you die, there can be capital gains taxes owed if the beneficiary receives the property at this price and then sells it at another price. But let's talk about what happens with what you paid for it and what they inherited at, which is the cost basis change. I think this is probably easiest to understand if we use just a hypothetical couple, Fred and Wilma, to talk about how assets get what we call a step up in cost basis. So if Fred and Wilma buy Apple stock at $10,000, it is now appreciated to $1 million, and they both pass away, because we're trying to keep this simple. Their children will now inherit Apple stock, and their cost basis will now be $1 million. So if they turn around the day after Fred and Wilma pass away and sell that stock for $1 million, they will not owe any capital gains taxes. If that Apple stock goes up to 1.1 million by the time they sell it, then they will owe capital gains on that $100,000 of gain. So I think that's pretty straightforward. Where it gets a little more complicated, a few more rules involved, is what happens if Fred passes away. What happens to that stock if Wilma decides to sell it? So let's say the same situation, Fred and Wilma buy Apple stock for $10,000 and it is now gone to $1 million. And Fred passes away and Wilma decides to sell the stock. Well, she will actually, in most states, she will get a half step up in cost basis. There's a lot of planning around this that we're not going to get into. So her cost basis will effectively be stepped up by half of the gain. So the gain would have been $990,000. I'm not going to do all the math on that, but her cost basis would roughly be $500,000. So now if she sold that stock, she's going to owe capital gains on the other half, the $500,000 that was not stepped up when Fred passed away. Now there are 9 states that are community property states. They are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. And a bonus, if you live in Alaska, you can opt into community property. What that does is essentially treats it the same as it were for the kids. So if you live in one of those states, Fred passes away, property goes to Wilma, gets 100% step up in cost basis. All the other states, it's a half step up in cost basis. This also applies to your real estate. So if Fred and Wilma are living in their property, Fred passes away, Wilma decides to sell and downsize, her cost basis in the property is actually stepped up only by half. As far as taxes go, she could owe some taxes on that if the property has gone up enough. And again, there's some other stuff in there. And the last thing that I think is really important to know is that this can also work in reverse. So let's say that Fred and Wilma bought Apple stock for $1 million. And when they pass away, Apple stock had gone through a major downturn and it was worth $500,000 when they both pass away. The cost basis in that Apple stock will actually drop down to that 500,000 mark. So if they pass away, the stock goes on a roar, and then the kids sell it for $1 million again, even though it's back to that original cost basis, they're actually going to owe capital gains on that $500,000 of gain. So it does work both ways, which is something we don't tend to think about. Things can drop in value. We've seen it. And people can pass away when things drop in value. And yes, that cost basis will actually receive a step down in cost basis. Like I mentioned, a lot of planning opportunities around this cost basis adjustment that we'll probably try and get into in a future video. But for today, I really just want you to understand what cost basis is as far as thinking about our next generations and how it works. And even for our surviving spouse, I just want you to understand how those things move around and can create different tax consequences for the people that you leave those assets to. So that's it for today. I hope you enjoyed this video and I hope you learned something. If you're new to the channel, please don't forget to click that subscribe button. If you did like this video, click that like button for me and we'll see you on the next one.